If you're looking for ways to improve your finances, you've come to the right place. Now, it's not just every day or every month that you see a mutual fund house that manages to perform head and shoulders better than the benchmark as well as the rest of its peer group. But Quant AMC has managed to do just that. What's the reason behind that outperformance? And is this something that you should pay very close attention to? Now, our second chat relates to the rising interest rates and whether this means that you need to adopt a different strategy when you're planning your investments. And finally, on our Fitness Friday chat, we discuss diabetes. There's a reason why India is the diabetes capital of the world, and we talk to a leading diabetologist to find out the early signs of diabetes and also to find out the care that you need to take to avoid the disease, as well as what you need to know if you are already diabetic. Let's start with the first chat of the day though, and it is about Quant AMC, which is a relatively new entrant to the mutual fund space here in India. And if I look at a couple of its schemes, most of its schemes have outperformed, but I'm looking at a couple of its schemes. One is the active fund, the Quant Active Fund, which is essentially a multi-cap fund, and the other is the small cap fund. The active fund has outperformed the benchmark by a significant amount. I look at the last 1 year, it has gained about 12.5%, and it has beaten the category, which has gained by about 9.3% on an average, and the benchmark has gained about 8.2%. But the real outperformance can be seen on the 3-year period, which has seen it gain about 29% in that time, and the similar case with small cap fund as well. But I'm joined by Kaustubh Belapurkar, who's the Director Fund Research at Morningstar Investment Advisor. Thank you so much, Kaustubh, for taking the time. As I was pointing out, and you have all the data in front of you, you've looked at this in a lot more detail than I have. Could you give us a sense of the kind of outperformance that we've seen in these equity mutual fund schemes?
Hi, Alex. Thanks for having me in the show, and hello to all the viewers. So you're right. I think there's been a lot of buzz and interest around the equity funds that have been managed by Quant AMC. Like you said, relatively new because obviously they took over in while AMC, and they've been restructuring the funds and portfolios over the last 3 odd years. And really, if you look at the more recent performance, especially over since the COVID crisis or even before that, you can see that there's a fair bit of outperformance that quite a few of their funds have generated versus some of the for instance, some of the numbers that you spoke about when you think about it on a pure point-to-point basis, right? But when you start, and I'm going to play look at both sides of the coin here. When you look at how the performance has been delivered, and we look to slice and dice on this performance on a month-to-month basis just to see where have been the periods of outperformance that have come in. So we noticed a few months, and specifically talking about the two funds that you mentioned, the active fund, which is a multi-cap strategy, obviously since the multi-cap category was announced, and the small cap fund. You can see that particularly post the COVID crisis, the funds have been doing extremely well, like we spoke about. But there are particular months in which they've done exceedingly well, right? And I think that's the interesting bit to kind of typically we won't look at monthly returns, but given the staggering amount of outperformance that has come in, made us stand up and take notice. For instance, in the month of July of 2020, the small cap fund was you look at it on a relative basis or an absolute basis, was up almost about 23.5%, versus the small cap index of the BSE at about 5.3%, right? So that's a staggering outperformance, and pretty much all the peers would have been plus or minus a couple of percentage points on the benchmark, right? So that's a staggering amount of outperformance that's come. We've seen similar months that have happened, since that time. So September was another classic case where there's about a 5% absolute outperformance. But on the flip side, we've also seen months where the performance has been relatively significantly underperformed, right? So if you just slice and dice, and the point why I'm making this is that the point-to-point performance is great, but obviously what can happen with strategies like this, we'll obviously talk a little bit about how they're different from the rest of the people in the street. But it can be a little lumpy or a little more volatile, than the benchmark and the peers. So while the end result looks great, you have to also look at how the journey's been in the middle. And I think that's where I'm just trying to articulate that there have been significant amounts of outperformance that have led to this excess outperformance that has come in. But is that necessarily going to be the trend going forward? That's something that obviously we'll sort of debate and discuss in the next 10 to 15 minutes.
Guess if you could, put it in a way that everybody can understand, if you're running a race over the course of a kilometer and you run the first 500 meters very, very fast, and then the rest you can choose to go a little slow and you'll still reach faster than everybody else. It's similar, right? So let's talk about how they're managing to do this and why this is taking place, because it's interesting. In the literature that is available on their website, the investment philosophy that they have, among the other things that they've talked about, Kaustubh, they call themselves unconstrained, if I'm not mistaken.
Yeah.
And that is visible in the holding pattern that they have in their mutual fund schemes. There's a lot of change. There's a lot of churn. They don't seem to be the kind of fund managers that want to hold on and stay invested long term. Is that what explains the outperformance?
Sure, Alex. So let's, and for the interest of the investors, I think it's very important to draw that distinction. So firstly, I think it's interesting that, we have like a, pure breed quant or bunch of quant strategies that are now available to investors. Globally, obviously, quant strategies do form, significant, a reasonable portion of the asset management industry. So it's nice to see that. Obviously, it's still early days. But, where this strategy is obviously different. So when you talk about any typical diversified equity fund, what you would see is most fund managers will focus on fundamental investing in terms of looking at good, well-managed companies that are, growing profits or are cheaply valued as per their intrinsic value, and they would look to invest in those, right, and buy and hold, right? I mean, that's what a typical diversified equity manager would look to do, and they would, every manager would typically follow a particular style. And even when you look at sector exposures, they would tend to, be around the benchmark with a little bit of underweight, overweight. That would, for most traditional diversified equity managers, when you look at it from an Indian context. Now, obviously, from these particular strategies and, from their own stated philosophy, they are unconstrained. And that's obviously what we've seen in the way they've been managing the funds over the past 3 years. And they look at market indicators and signals, when you read their literature and look at the information that they're looking at various sentiment indicators, liquidity indicators, and several other sort of market indicators, be it volatility, fear and greed, and things like that, to assess and analyze what sort of stocks or what segments of the market should they get into and get out of, and they're quite quick to get in and out, right? So that has resulted, as you alluded to, that there's a fair bit of turnover, churn in the portfolio. Which I think is a sort of part of the professed strategy that they would follow, right? And there are things which I should talk about, that they have probably the indicator seems to have kind of helped them be ahead of the curve in certain instances, and I'll share some examples. For instance, we know healthcare stocks did exceedingly well post the COVID pandemic sort of hit us, and when I look at the the healthcare exposure of these two particular funds, they were north of 30%, both in the active and the small cap, which is significantly higher than, potentially what the benchmark or the peers would be holding. So obviously somewhere, you would see that, is there proof of the pudding that the indicators seem to be giving them early sort of signals to get into a particular space? Yes. The same thing I would see that, for instance, the active fund, which was an unconstrained, obviously now multi-cap, sort of boundaries are coming, but early 2020, they were sitting very low on small and mid caps. The COVID crash happened, and they added significant allocations to small and mid caps from the part of the portfolio, right? So the point that I'm trying to make is that there are things that look to show that perhaps the signals that they're using to get in and out of stocks has worked for them in certain segments. But again, I take that a little bit of a pinch of salt, because, like I said, it can be quite lumpy. The performance, like I explained, that you can have what we call feast or famine in terms of relative outperformance of the strategies, and even if you look at the strategies today, they are running slightly higher than market beta, right? So the beta is running at about 1.2 to 1.1 to 1.5%. So they would tend to rise more than the market, at the same time fall more than the market, as you'll see in the more recent month, where strategies have fallen more than the market, albeit not significantly so, but yes, they have fallen more than the market in this point. So I think that's something which investors need to keep in mind. That this is how these strategies are different from your traditional, fundamentally research buy and hold strategies. There will be a lot of movement in and out of the portfolio. We spoke about the turnovers of the portfolios have been, typically most of them would be around, between the 50 to 100% mark. But, these funds traditionally have had probably 200, 300 percent upwards. That means there's a lot of changes happening. And I'll give you an example. If I look at the portfolio today of both the strategies, holding about 55 to 60 stocks, and I go back a year and I see what is the commonality between the two portfolios, just in terms of the number of stocks, I think only about 20% of the 20 to 25% of the stocks were held about a year back. So obviously there's a lot of changes that happen to the portfolio, and they will get some big bets right, as we've seen that's happened in the past. And even when we run attribution numbers, we can see there are certain stocks that have attributed to a significant outperformance, for the portfolios. But I think the proof they're putting to our mind, and that's where it's important that they've scaled up assets most recently, right? So if you look at the assets of the funds, 12 months ago and where they're standing at today, a lot of money from investors has come in the last 12 months.
But Dhaval, before we get to that, I want to talk about a few more assets. I want to speak about a couple more aspects, right? You mentioned the beta is high, but at the same time, over the last couple of years, they have demonstrably shown that they have downside protection as well. Could you talk about that aspect to it? When on the one hand, you're seeing that there is a significant amount of churn in their portfolio, but at the same time, they've managed to limit downside. How do you think they managed to do that?
Yeah, so I think, the classic case was that during the COVID crisis, and, I alluded to that, they had the early signals that probably indicated to them to load up in healthcare, which they did, which was a lot more defensive when the COVID crisis hit. So, that's when their down capture ratios, as we look at it from, how has the fund done in the downtrending market, has helped. And, the point is that because they're so unconstrained, they could be at one point, their signals could be telling them to be running a low beta strategy, which was the case back in 2020. But as things stand today, they are running, north of 1.1%, like I said, 1.1 times market beta. So I think even the beta will be quite fluid. And, that's the thing that it's important to highlight to investors, because I said the returns can be lumpy. So, you don't, one is peg expectations, because obviously they've had some significantly good months, and, the point returns look excellent. But it's not like, it's going to be one-way journey, or it's going to be a very smooth ride. It is going to be a rocky ride, but that's something which I think is par for the course for a strategy like this, which would continue to churn in and out of, stocks. That's something investors need to keep in mind, because it's not like, it's going to be a strategy that can work across always in every market cycle. That's the other thing that we want to see demonstrate. How does this strategy do on two fronts? One is, when this, look at it over a market cycle, and as assets continue to scale up, right? So that's the other important thing in terms of capacity and liquidity of the strategies. What you could do with a 200 crore fund or a 1,000 crore fund can the same be replicated to the same element with a 4,000 or 5,000 crore fund is something that still needs to be witnessed. So that's the sort of, just playing the devil's advocate is something that I would be very keen to look at.
Please stress that point. But before we get to that again, I want to talk about how you would benchmark this, because yes, there is a comparison that you draw, and we spoke about it at the start of the program, the fact that they have outperformed their peers, but you also alluded to the fact that there isn't a quant strategy that is employed here. Could you first describe how a quant strategy normally works, and how would you compare maybe this fund to something that happens across the board, maybe outside the geography of India? How would you describe the strategy?
So, like I was alluding to it again, obviously there's information based on, what they've publicly shared, because, their model is obviously their secret sauce, and that's not something that they've publicly shared. But I think the idea is to look at more, indicators, market-based indicators, sentiment-based indicators to do that. And there are several sleeves of quant strategies that you will find globally, right? They could be quant strategies that are, maybe targeting a certain factor. This is completely agnostic to that. While I might see a little bit of momentum that's there, but that's probably just a part of, the indicators that leads to a momentum bias. But, globally you would find, specific, say, factor strategies. Some of the successful guys who run would probably either be targeting high vol or low vol or momentum-based investing and things like that. So I think this is a new unexplored area from an Indian context, and that's why I think it's an interesting thing to look at. But still early days because we want to see how this does. Like I said, over a market cycle, we've always had fundamentally run strategies, like I spoke about. There've been some elements of quant strategies, but that were also, with a large element of fundamental analysis attached to it. Which we've had a few quant strategies in the past. So this is in that way completely unconstrained. Tomorrow, I mean, obviously a small cap fund will be largely invested in small cap, but for instance, the active fund within the constraints of its mandate could run up to 50% in the large caps or come down to maybe just 25, when they think that smaller mid caps make more sense. So it is unconstrained in that way. They're not following a particular style. Like I said, they loaded up in value in 2021 when it looked like the indicators were saying that value might be making a resurgence. It did. That's also helped them. So I think that's the unconstrained bit. That's interesting to see how that plays out over the market side.
Absolutely, because in conversations that I've had and in looking at this as well, you can't really fit them into any of the traditional buckets. They're a little bit of everything, or maybe not a little bit of everything, if you can call it that. But to the point that you were making, and I'm sure a lot of people are interested in this fund house. It is very clear in the growth of AUM that has happened over the course of the last couple of years. They're still relatively small, but I want you to explain what the potential pitfall could be, because is it the fact that right now they are incredibly nimble and they're able to churn their portfolios very, very quickly, but at some point of time, if they continue growing at this pace, they will have to take a few steps back and be a little less aggressive in the change of their portfolio?
Sure. So two things, and let me address. One is obviously about the portfolio construction, the nimbleness, like you spoke about. Yes, I think that's an important watch point because, like we said, the strategies have scaled up, and while they're still relatively small, there's a fair amount of interest from the investor community around this, given the the recent track record and the performance that they've created for themselves, right? So, and given that typically even for a buy and hold strategy, it becomes difficult when you're trading in the small cap space, especially where liquidity can be a challenge. As you continue to scale up assets, can you move in and out without really impacting your exposures significantly in terms of impact cost is something that I think that is going to be a watch point. Very, very important. The other is capacity, because, are you going to be maintaining the same sort of strategy, because your indicators tell you these maybe 20, 30, 40, 50 stocks that you're buying. But remember that they're running 5 other strategies. And that's the other thing that we've noticed, that obviously there is a reasonable amount of commonality between, for instance, between the small cap and the active currently stands at about 40% of the portfolio. Weight for weight is similar, right? And last year was about 50%. So that number can change. But even the other strategies that they manage, there are strategies where there could be commonality between a couple of them at 60, 70%. So the point is, can you at capacity scale as your assets continue to grow across the board is something that definitely is going to be a watch point. And from an investor's perspective, and that's very, very important because, and why I harp upon that, the performance has been great, but, it's been feast or famine. When I look at it from a month-on-month basis, is because when we think about the way investors have invested in these funds over the last 12 months, just as an example, the small cap fund is at, I think last I saw is about 1,800 crores in assets. About 1,300 have come in net flows in the last 1 year, right? So almost 67% of your today's AUM is just about a year old, actually much less than that. If I look at an average, maybe just 6-7 months old. Now, when you think about the concept of investment return versus investor return, so we all know that the small cap fund has done significantly well, almost 38% over a 3-year CAGR, which is great. But when I think about it from an investor return, what is an average investor made in this fund? It's actually almost half that, which means that an average investor, because they've come at different points of time, have only made about 17-18% of the small cap fund on an average, because they've seen the past performance and come in. Maybe some of those good months of performance have already gone. And that's where you need to peg the expectations of investors that it's not necessary that this significant outperformance can continue the same sort of quantum. That's something that investors should keep in mind and not over allocate to such strategies, saying that, look, I'm just going to, because we've heard queries from investors that I'm putting half my money in my portfolio into strategies, and any strategy for that matter. You should never be over allocating to any strategy, especially just looking at pure past performance and coming. And I think that's the thing that I would want to advise investors, that always take graded bets if you want to, and remember that these sort of strategies you need to evaluate over a market cycle. They can be volatile, and we've shown periods. Obviously, there are elements to where you can see that the model is working for them, but let's see more proof to pudding as they scale up and as the market cycle sort of plays out in a different way.
Important points that you've raised, particularly at the end in terms of advice, and I hope that my viewers have taken that, because you say on and on, right, Kaustubh, your past performance is no guarantee of the future, and I hope that this conversation has helped people understand at least a little bit about how they've managed this outperformance. Of course, we don't really know how they're managing the construction of their portfolio. I hope at some point of time we'll be able to have conversations with them to find that out. But I think we've had a productive conversation. Thank you so much for taking the time.
My pleasure, Alex. Thank you so much.